Okay. Okay, good afternoon, everybody. How are you doing? All is fine? I have printed out your exam. What questions do you have for me? What do you need to know beyond what is mentioned on the Musafai? The fact that it covers all the material we covered from the clip now. It is supposed to cover ratio analysis also, but there is no question about the ratios. So the ratios and the ratio analysis, what we're going to do today, is more relevant to your full project than to your exam. But of course, day-to-day entries, financial statement, closing entries, adjusting entries, all are exam duration is 100 minutes, 1 hour 20 minutes. It will be done during the regular class time, so here, proceed. It includes 4 problems. It is marked out of 100 marks, 100 minutes, 100 marks, which means any problem which is marked out of 20, that means don't spend more than 20 minutes on that. It is time to help you manage your time also. It is also lots of time management. So every problem will have that problem is marked out how much is the monthly schedule for the problem, and that will indicate also the optimal time to spend on every problem. All questions, as agreed, as discussed, as I said, are taken as they are from your connector side. All problems are problems that you have already done as part of your connector side. That was my promise, and I do it exactly as promised. So they are taken as they are from connector side. When I say as they are, means I have sometimes reduced the problem, but didn't add anything else. Okay? Some question I removed some transaction, or I removed some question, or but the data and everything is taken from your connector side. And you will have the right to have one cheat sheet, one double-sided paper, whether it is handwritten or printed, as it's up to you. That's it. This is all I have. And then have a question about this. Okay, so no surprise. It is all about questions that you have already processed on Connect. 4 problems.
Yeah. So these 4 problems are assignment 1 and 2.
Sorry?
These 4 problems you did assignments 1 and 2.
1 and 2, yeah. The assignment that cover the chapters covered by the 2. Yeah, exactly. 1 and 2. Assignment 1 and 2, there's something like 12 or 14 problems. 4 of them are taken from you.
Say again, sir, the cheat sheet is allowed to be double-sided?
Yeah, double-sided. One sheet, double-sided. Okay. So now some practice regarding ratio analysis. Don't forget your project is also worth as it has as the same weight as the midterm, right? 30% each. So even your project is also crucial for your success. So make sure to do it, to make the necessary effort on it. So this is the list of ratio expect to see in your report. Okay, again, not all of them. So this is the full list, not all of them, but select from every list, but I expect all aspects to be covered. There should be a section about profitability ratios, profitability analysis, asset turnover analysis, liability, liquidity analysis, solvency analysis, and market analysis. But which ratio you select, it is really up to you. And in order for your report to be, in order to make your selection smart and beneficial in terms of marks, you have to select them in a smart way, which is simply, if let's say I have two companies, company A and B, okay? Means you are supposed, my recommendation is you have to calculate all 18 ratios on your draft, on your Excel, not on your report. All the calculations done. If I take one ratio families, for example, and you make your calculation ratio 1, ratio 2, ratio 3, ratio 4, okay? And you decide that among these 4 ratios, you're going to take 2 only. This is the space you have. Presume the ratio 1, the result is this: 1.04 for A, 1.06 for B. Ratio 2, 76% for A, and 74% for B. Ratio 3, 32% and 97%. And ratio 4, let's say 3.21 and 2.61. Among these lists, what would you select for your report? It's marketing. Yeah.
Well, the ratio
3. Probably if I have to take 2, it should be 3 or 4. Because if I take 1 or 2, what am I going to say? They are almost similar? Okay, that's fine, it's similar. The story ends there. There's nothing to elaborate. But here, I have to elaborate. I have something to say because the gap is significant. It is a big difference. And whenever there is a big difference, means there is something to say. You can elaborate, you can search, you can decide which one is better, which one. You can't say this one is better if you only select the ratios that are very close. This is your the recommended strategy of what should be. So a ratio is again a ratio is simply numerator divided by the denominator. So the first step is calculation, and then after that interpretation. So in your report you will have to make in the appendix the calculation, the way you calculate. You don't put the calculation. In the report, I need just to see the result. I need just to see the numbers here. How did you get there? That is in the appendix. How did you get to 1.04? Let's say current asset divided by current liability. The detailed calculation in the appendix. The calculation, the result of the calculation, and the interpretation. The report is basically about interpretation. How do you interpret? How do you what conclusion you do when you compare the ratios? What is a ratio? Numerator divided by the numerator. Why we do this? In order to convert the dollar amount in the second first position into percentage, so that we can compare and we can eliminate the size effect. Okay. First practice on this, I have a company. Okay, so this is for a single company, it is not about comparing two companies. This is cross-time comparison. Cross-time, which means same company over time. This is for this company. These are some element of financial statement for the year 21, 22, 23, 24. Cash, account receivable, inventory, prepaid expense, total current assets, and then element of current liabilities, account payable, accrued salaries, other current liabilities. The question is, calculate the current and quick ratios for 2021 to 2024. Current ratio and quick ratio formula are here. So these are to assess how liquid is the company. When I say liquid, the ability of the company to pay out their short-term liability. That is what the company is highly liquid. Highly liquid means have enough cash and enough current assets to cover their liabilities. What is the current ratio? Current asset divided by current liability. Just apply it as it is for every year. Current asset divided by current liability. So for let's do for 21 and 24, for example. Numerator, current asset for 2021, current asset 7,500. Denominator, current liability, denominator, the denominator for 2021 is current liability, this. So for 2021, let's put this. Current asset divided by current liability, 211%. 211%, is that good or bad? I don't know. It depends on what was the ratio before, last year or the year after, so that I compare. Or it depends if this is company A and I make the same calculation for company B, then I can compare. And I can compare which one is better. But just making a calculation for a single ratio for a single period does not allow us to make any conclusion. We make conclusion if we compare with another. So if we say, for example, let's do it, this is 2021. How about 2024? So if we do, so for 2024, so that we compare, okay? On 2024, the numerator, which is current asset, it goes up to 3,048,000, and the denominator divided by the denominator on 2024 is 2,156,000. Now, the result now is 141%. Now you can make an interpretation. What do you conclude? Is it good news, bad news, improvement, deterioration? How do you interpret this? They had a current ratio of 211% in 2021. 3 years later, it goes down to 141%. What is your interpretation of this? Bad news, of course. So the liquidity is deteriorating, because it means at in 2024 we had enough. So this is really what you have to understand for your report. This is the interpretation, because the calculation is just in the appendix, okay? But the interpretation is what will be in your report. So the interpretation we make here, 3 years ago, we had enough current asset to cover twice of our liability. Twice of our liability. Enough. More than even twice. Now, we just have even less than 1.5. We can cover, what we can cover with our current assets is just less than 1.5, 140%, which reflects that there is a decline and there is a deterioration of the liquidity of the company. Current quick ratio. So the quick ratio, it will measure the liquidity, but not usually. We have to remove from the current assets. So here, understand a little bit the philosophy of the liquidity. The concern of the bank who is going to borrow you money is, do you have enough liquidity to pay back the loan? Okay? So show me that your liquidity is good. What we mean by liquidity, short-term asset liability, which means you have enough short-term asset to cover your short-term liability, right? Now you may say, listen, look at my numbers. On 2024, yeah, I have means I can cover, I have 3 million of current assets, while I only have 2 million of current liability, which means I can, if I sell my current asset, I will be able to cover all of my current liability. The bank would say, okay, I understand that you can use your cash to cover your current liability. I understand that you can make pressure on your account receivable, collect them to pay your current liability. However, you can't tell me that inventory is something available for you, something you can immediately convert into cash. So let us remove the inventory and keep only the quick element of the current asset. What does it mean, quick? Those elements that could be quickly converted to cash. Okay? What could be quickly converted to cash is cash itself plus account receivable. Inventory is not something you can quickly convert to cash. So the quick ratio is going to take only the the quick element of the current asset, cash and account receivable, divide them by the current liability, and see how much percentage of the current liability are covered by quick asset, which means those elements of the asset that could be quickly converted into cash. So let's do it. For 2021, the numerator for the quick ratio for 2021 is cash plus account receivable. The denominator is the same, always the full current liability are used. So for 2021, we were able to cover up to 1600 divided by this, 46%. Almost half of the current liability could be paid back using the quick assets. What happens to this ratio in 2024? Now in 2024, it becomes equal to current cash 2024 plus receivable 2024 divided by current liability 2024, and now 21%. That's a big deterioration. Now only 21%. A fifth of the liability only could be covered with quick current asset, those assets that will be converted quickly to cash. So this is an illustration of the calculation and interpretation of the ratio. Calculate the current and quick comment on the liquidity, and is your analysis in part 8, 10, analysis. Okay, so this is cross analysis. Any question about this? So now, what is the challenge on this exercise? The challenge is, first of all, to be able to identify where I can find the numerator, where I can find the denominator. This is the first challenge, okay? Should I use the income statement? Should I use the balance sheet? Where can I have the information? And then, of course, calculation is easy. Once I get the numerator, denominator calculation is easy. The biggest challenge is interpretation. Being able to qualify the situation as good or bad, as an improvement or a deterioration, as A is better than doing better than B on this, or B doing better than A on this. Excuse me. Okay, so next practice. Financial information for this company is annual cost of goods sold, inventory, beginning inventory. So this will allow us to practice these ratios, the turnover ratios. Okay, this practice is about turnover. And whatever we will do now with inventory, it works also for
yeah, same principle and same process applies to receivable and applies to liability. So we have the cost of goods sold for two companies. This case now it is a cross-company comparison, not cross-type. This one is more similar to your project where you have company A, company B, the information from company A and company B, cost of goods sold, inventory at the beginning of the year, inventory at the end of the year. Okay, and the question is calculate the inventory turnover. Okay, how do I calculate the turnover of the inventory? Get back to the formula, that is not a secret, available for you. Inventory turnover, on the numerator the cost of sale, on the denominator the average inventory. Cost of sale in the numerator, denominator average inventory. One would ask why average? Why we just have inventory at the end of the year?
Was that supposing you're going from 0 to your current asset instead of actually looking at the growth from the start of the year, from what you started with?
The average means, okay, let us do the calculation and then I will ask again my question. Okay, keep this question aside and then try to think about the answer to that. Okay, let's do it. So here, I have two companies. I have the opening balance of the inventory, the ending balance and the inventory, and the cost of goods sold for every company. So, to calculate the inventory turnover, the numerator is the cost of goods sold, right? This is cost of goods sold. So this is for the first company, M&G. Cost of goods sold for M&G is this. The denominator. How do I calculate the denominator? So it says in the formula the average. So how do you calculate the average? Average between what and what? Between the opening and the ending. We started the opening on January 1st with $78,000 inventory. We ended the year with $69,000. So the average is this plus this divided by 2. Simple average, right? So the denominator is for M&G, opening inventory plus ending inventory divided by 2. And this is here. Where are you going to bring this number? In your project. If you need to calculate the turnover, where do you find this and this? Okay, where do you find the cost of goods sold? Which statement? You need the cost of goods sold in the numerator. Where are you going to find it? Which financial statement? In the income statement. Very good. How about the opening and ending amount of the inventory? Very good. The last, because on your financial statement you will always have comparative 2 years, 2 consecutive dates. So December 31st, 24, that is January 1st, 2025. Okay? So you take the inventory from last year plus inventory from this year, that is the opening and ending balance. Because in your statement there is no December 31st and January 1st. No, there is December 31st of last year and December 31st of this year. December 31st of last year, that is the opening balance for the current year. So if your statements are about 23 and 24, so you have inventory, the balance sheet numbers for December 31st, 23, and December 31st, 24. That is what you need as opening balance and ending balance, and then you divide it by 2, you get the average, okay? Now the ratio is numerator divided by denominator. And this one is calculated in times, not percentage. So the turnover, inventory turns, if you like, the rotation of inventory happens 18 times a year. 18 times a year, so the inventory is renewed 18 times a year. So the practice here, because it is hard to compare to understand 18 times a year, The practice is to convert it into this other ratio, which is the days to sell. Okay, and that one is simply in the numerator 365, which is the number of the years, the days in the year, divided by the ratio 18,000, and then you can get it then in days. Okay. See, if the inventory is rotated or replaced every 18 times a year, then it means it is renewed every period of 20, every window of 20 days, you have renewed your inventory. This is what we use usually to compare. 20 days is the days to sell inventory, okay? This is the ratio for A. Now again, to my question. The numerator is the cost of goods sold that, as you said, comes from the income statement, right? The denominator, one would say, why I should take this plus this? Why we are doing the December 21st, let's say 24. This number is for the period 24. This number is December 31st, 24. Why we simply don't divide this by this? Why should we calculate the average? Again, this is the numerator comes from the income statement. The denominator comes from the balance sheet.
Because the income statement is the annual.
Very good. The income statement covers the period, while the balance sheet is about the single day. It is statement of financial position. It is about the position in a single day. It doesn't make sense to put in the numerator a number that reflects the period, while in the denominator a number that reflects a day. Doesn't make sense, not comparable. But when we convert the denominator into a period, because if you say, this is what I started the year with, this is what I ended the year with, on average, the inventory was $74,000. That $74,000, because it is an average, now it represents a period. That way I have a number that represents a period on the numerator and a period on the numerator. Now it becomes consistent, comparable, and now I can make a conclusion. Now again, 20 days doesn't mean anything until I compare it with the other company or with last year or next year. So let's do the same calculation for the other company. The other company, what is their turnover inventory? So numerator, cost of goods sold, okay? Denominator, the average of opening plus ending divided by 2, simple average of the inventory. The ratio is this divided by this, 64 times, okay? If to make it more concrete, more easy, easy to understand and to interpret, we convert, the practice is to convert, instead of times, convert it into days. Okay? It is better to compare days rather than times. So all I have to do is to put in the numerator the number of the days of the year, 365, divide by that ratio we have just calculated, 68 times, and then we can conclude that this company will renew their inventory every 6 days. This company renewed inventory every 20 days. This one, their inventory, the rotation is every 6 days. What interpretation do you do with this? Which better, which good, which bad,
Second one is faster.
yeah, which is good, right? Yeah, this is what we need. Faster, okay, which is good. When you can renew your inventory more quickly, the day to sell is shorter, that is good. So in this perspective, company B is better than company A. Okay? And again, for your report, you will have for sure cases where company A is better than B, and other cases where company B is better than C. Then the third challenge is to make a decision.
Okay, if over the 11 ratios you include in your report, one of them has 8 times better than the other, maybe the decision is easy. Okay, 8 times company B is better than company A, and only 3 times company A is better. Maybe the decision is relatively easy. But if 5 times versus 6, then you have to make your professional judgment and to decide that even though company A is a little bit has more ratio where it is better, however, some ratios do not have the same weight, the same with regard to the needs of your investor. So you have to think about strategy to decide if they are comparable, which one is better, considering the needs of your client. Your client is the investor you are going to recommend. You're making a recommendation to investors, to a fund, right? To a trust fund, so that you tell them, based on our analysis, we recommend that you invest more in company B and C. So you have to justify again your recommendation. Okay. Any question? Let's look at this practice here. It is about the debt to equity, solvency, and the solvency ratios are here. Solvency ratios. The difference between the liquidity and solvency is liquidity is short term, solvency is long term. Liquidity short term is to which extent the company is able to cover or to pay on short term basis its current liability. That is liquidity. You can be good on liquidity, but you can have problem on long term. Okay, you can pay short term, however, in terms of solvency, on 5 years or 10 years range, you have a problem, and you can go bankruptcy because of this. That's why both have to be good. You have to analyze and observe both long term and short term. These are the list of ratios used. For example, times interest earned is to measure to which extent the company will be able to afford interest and new loan, because new loans come with new interest. Are you able to pay interest? Do you have enough margin in your earning to afford new interest? So the way you calculate it, net earning plus interest expense plus the income tax expense on the numerator divided by the interest expense, so that you get the times interest earned ratio. Cash coverage ratio is the cash flow from operating activities. This is in the cash flow statement divided by interest paid. And the debt to equity ratio is total liability, total, which means short term and long term, current and non-current, divided by the shareholders' equity. So, what is required here? So, we have the following financial information relates to this company. So again, this is a cross-time comparison. A single company, 3 years, 22, 23, 24. We have the income before depreciation, amortization, interest and taxes. We have the interest expense, cash, current liabilities, the bank loan payable, shareholder equity. Tell me each of these, where does it come from? Where do you find this? Income before depreciation, amortization, interest and taxes. This comes from the where do you find this? Which statement? Before you go to the calculation, you have to identify what you need. You have to identify the numerator. Where does it come from? So income before depreciation, amortization, interest and taxes. We'll seek this information where? On that? Income statement, of course, not in the balance sheet. Go to your income statement, and you won't have something which is called like this. You have to calculate it. You won't have in your income statement something called a title or a subtitle called income before depreciation, amortization. No, it doesn't exist.
You have to calculate it, which means get to the net income and then remove the depreciation, amortization, interest, and tax. Get back. Okay? I ended with, let's say, net income. In my income statement, I have all the elements, revenues, expenses, and then at the end of the day, I end with a net income of 120. Okay? I won't have a subtitle in the middle. I will have, for example, a subtitle which is called gross margin. Okay? At some point, which is sales minus cost of goods sold. I would have another subtitle called income before tax. Okay? Before tax. Okay, I have the number here, minus the tax expense, and then I get the net income. But I will not have a subtitle in the middle called income before depreciation, amortization, interest, and tax. I don't have this, so which means I have to calculate it. So which means I get my net income, this one, 120, and then add back the item that need to be removed. So it means the depreciation expense, and add back the amortization, if any, and add back the interest, and add back the tax, income, the income tax. Why plus, 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 not minus, 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 minus? Why should I add them and not subtract them? Because this is the net income. The net income. All of these are expenses. So they have already been subtracted. These items, the depreciation expense, the interest expense, they all have been subtracted to get to the net income of 120. If I need to remove them, I have to add them back. It should be plus. And then I get, for example, let's say 230. That is what I need. That is my numerator. Okay? Here we have it calculated, ready to use, but for your report, you will have to do it. You will have to find yourself the 6900. It won't be given to you, and it won't show up as is on the income statement. You have to make this calculation. You have the net interest expense, the cash, current liability, and bank loan. And the question is to calculate the debt to equity ratio. Debt to equity. How do we calculate the debt to equity ratio? In the numerator, the total liabilities, and the denominator, the shareholder equity. Okay? And the numerator for 2022. The numerator, total liability. How do I calculate this? What do I include? What should I include if I need to calculate the total liability? So the liability? Shareholder equity is not liability. It is equity. But in the numerator. Yeah, the loan payable. The loan payable is a liability. This is a long-term liability, and this is a short-term liability. So both together in the numerator, we have to put all the liability as. So which means then in the numerator, the current liability for 2022, current liability plus the bank loan. Okay, that is my numerator. My denominator is the shareholder equity. Shareholder equity is given as is. Take it as is. Equal 6,500. Okay. One may say, why the shareholder equity? If I have the number for last year and this year, why don't calculate an average between both? The answer is no need. Because your numerator comes from the balance sheet, which is related to a specific day. Your denominator also comes from a balance sheet, which is also related to a specific day. Numerator, day,
denominator K, there is no need then to make any adjustment, right? So the need for adjustment, and when one of the elements comes from the income statement and the other comes from the balance sheet, then that would be problematic. So having a numerator from the income statement and the denominator from the balance sheet, if we don't calculate an average, that will be problematic. But here, since both come from the balance sheet, no need to calculate an average. Now I have enough what I need to calculate the average, which is numerator divided by the denominator, 1. Okay, and you can see, even visually, you can see how it is 1. The shareholder equity, the liability is almost equal to the debt. Okay, 1. Okay, that's fine. Now to be able to compare, you have to do it for the next year, the year after. Let's do it for 2024. 2 years after. The numerator, again, for 2024, current liability plus bank loan. The numerator, the shareholder equity. And then I calculate the ratio. This divided by this, 1.04. What is your interpretation? Is a slight what? Improvement or deterioration? They are almost equal. Okay, if this was your report, your project, I would simply skip this ratio. Okay, for your project, because the difference is very, very non-significant. So I would seek for another ratio to calculate this, to assess the solvency. But still, now, if I have this 1 on 2022 and then goes up to 1.04, a slight what? Improvement or deterioration? A slight what? I have a higher ratio. Is that an improvement or deterioration? Deterioration, of course, because we are talking about the debt. You have more debt compared to your shareholder equity in 2024 than on 2022. That is not good. That is bad news, not a good news. Okay, so this is where you have to be to pay attention. So good and bad doesn't mean increase or decrease, goes up or down. No, good is not always up and bad is not always down. Sometimes when you go down, that is a good news. That is an improvement. Sometimes the opposite, depending on what you are measuring. And then where you use your expertise. And that's why we placed this topic after we have covered all the accounting process. Because now you know what is good, what is bad. Okay? Generally speaking, what is good for a company is assets and revenues. What is bad for a company is liabilities and expenses. So look at your ratio. What is it? How is it structured? Okay. And of course, equity is good also. Okay? Equity is good. Asset is good. Expenses is bad, of course. And revenues is good, and liability is bad. Okay. This is the debt to equity. So if this was your report, I would simply make the calculation and then skip it. Not telling. There's no story here. Okay? Similar. I won't dedicate space on my report just to say they are similar. Unless worst case scenarios, you do all the ratios of the family, and in both cases you find they are similar. So like this family of ratio only includes 2. Okay? You may have a bad chance where you calculate the first one and the second one and both are similar. Then you cannot, you need to have a title, a section in your report about market ratio. That is unavoidable. You have to talk about it. But if by bad chance both of them are very similar, then at that time you will say they are similar. Okay? In terms of market, they are similar. They have nothing to do.
You cannot make them different if they are similar, okay? So let's say this is your report, you make your attempt, you calculate this, similar, you decide this is not worth to be discussed. Okay, let's try another dimension of solvency. The debt as percentage of capital. So let's do, I need to focus on what is in your list. The other items to measure solvency, cash coverage. Let's do this one. Yeah, times interest earned. We can do this. Times interest earned, net earning plus interest expense plus income tax divided by interest expense. So here I have, what do I have as information? Interest expense coverage. I have the income before depreciation, amortization, interest, and I have the interest expense. Okay, so this is what I need. As a numerator, the earning before interest, depreciation. So the EBITDA is the earning before interest, tax, and depreciation, divided by the interest expense, which means in the numerator, I'm going to put we are in 2022, right? The first item, income before depreciation, amortization, interest, and tax. And in the denominator, the interest expense, 380. Calculate the ratio. This divided by this. How many times? They have enough earning to cover 18 times the interest. Okay, let's compare it now with the other company. The other company, it has not the other company, the same company, but 2 years later, means 2024. This is the numerator, and then interest, and then this divided by this goes to 12. Okay, which better? This is not very non-significant like this. This is a little bit significant, yeah. If I have to elaborate, I can elaborate. In 2022, they were able to cover up to 18 times the interest expense. They had enough earning to cover up to 18 times interest expense. Now in 2024, they have enough to cover up to 20 times. Is this an improvement or deterioration? Very good, an improvement, and clearly an improvement. So their ability to cover interest is better now. It goes from 18 times a year before. This is exactly what you're going to do. I don't know if you feel that your mandate for the project, you start to see now what you have to do and what kind of interpretation and calculation. This is exactly what I need, and I will also submit to you another report, good report that was done in another group, another context, as just for you to have an idea what a good report is. But of course, it will be different from yours because companies that you did not select, which means you cannot take any calculation, but just to have an idea of my expectation in terms of quality. Okay. Now let's take a break and then get back to this, and this will be really very, very relevant because on this practice, it is really very relevant to report. All calculation is done. All calculation is done. We won't have to do the calculation. We only will focus on interpretation, which is exactly what will be in your report. Calculation will be on the appendix. I'm not going to evaluate the appendix. I'm going to get a sample of your appendix to check few of your calculation, not all of them. Okay? I'm going to focus on your interpretation, presuming that your calculation is done correctly. Okay, I don't have to go to all of your 11 ratios to check all of them. A sample of 3 or 4 to make sure you did it correctly, that's enough for me. For the rest, for your report, I would presume that your calculations are good, and now how do you make the interpretation? So basically, most of the marks are about the interpretation, not about calculation. Okay, even though calculation is necessary, of course, you understand, if in my sample, 3 of your calculation, or 2 out of 3 of your calculation are wrong, then it will push me to check others, to enlarge my sample, right? To see what about the others, okay? But if I find, let's say, just one mistake on 3 calculation, I would consider that enough. I would consider that your ratio and the body of your report are trustful, and then I can focus my assessment to your interpretation, okay? So after a 10-minute break, we are going to, this is a long list of ratios calculated, ready for interpretation, and we are trying to make some interpretation. Okay, let's take a 10-minute break.